Financial trends in the energy industry is the topic. Phyllis Young is an attorney with the Aiken Group out of Houston, Texas.
Well, thank you very much for sticking around to hear my presentation today, this afternoon. It's always tough being the last speaker because you never know if everyone's kind of worn out by the end of the day or ready to head to the social hour. So I hope to keep this interesting for you so that you don't all run off and go to the social hour. My name is Phyllis Young. I'm a partner at Aiken Gump, Strauss, Howard & Feld, LLP, or we go by Aiken Gump. I practice in Houston. I've been practicing now, starting my 19th year of practice in Houston. I primarily work in the oil and gas and the energy space. Really the full value chain of energy, upstream, midstream, downstream chemicals. I've done a ton of oilfield services work, steel, pipe, OCTG, CRA, primarily finance work. I also do some mergers and acquisitions work as well. And while I consider myself to be a domestic transactional attorney, I've actually done quite a bit of international work as well. And I think partly that's just because when you're doing oil and gas work, you can't help but touch on doing some international work as well. I'm a graduate of the University of Texas for both my undergrad, where I was a finance major, as well as law school. While I was in law school, I clerked at a Shell Oil Company. I worked at Shell Oil Company in their legal department. I also worked at Exxon. At that time, it actually was ExxonMobil. They had just completed the merger in the tax department there. So working at Shell is really where I developed the interest in oil and gas and energy, kind of the whole idea of drilling a well and everything that went behind that. I knew I wanted to do transactional work. And I knew that, the cost that goes into getting the oil out of the ground. In some cases, companies would join forces, create joint ventures to pool their resources to get that oil out of the ground. There's stuff going on in the U.S., there's stuff going on internationally. I figure there's going to probably be a lot of international work, a lot of transactional work in this area. So I think I'll stick with the oil and gas industry. So I want to thank you all for inviting me. Thank you to Haley, who actually spoke on this topic a couple of years ago. So I'm glad it was interesting enough for you to invite me back to speak about it. To Haley and Bryce for inviting me. Thank you to Agrilife for having me. Thank you to the Canadian Chamber of Commerce. I've met a lot of people here. It's been a very welcoming community, so I really appreciate all the hospitality. I like coming to these types of conferences because you start to see themes. And so in some ways, it's kind of good to be the last speaker because I can kind of anticipate now what some of the questions might be and adjust my presentation, but you kind of start to hear some of the same sorts of themes, and in particular, I was listening to the presentation on succession planning, and it reminded me, on my father's side of the family, on both my grandmother and grandfather, they are all, some still are, farmers and ranchers, and so we're at that point generationally where, my grandmother passed a couple years ago at 97, her sister just passed at 95, and so we're transitioning ownerships of property and things like that, and it's coming on my generation to start managing that and understanding who owns what in the family properties and how to operate all that and manage all that process, and really how important it is to keep the family, the land in the family that's been the family for generations. And it reminded me, listening to the second presentation, about a story I always heard growing up about my great-grandfather and great-grandmother. Everyone calls them Papa Steve and Mama Mary. And they were farmers. And I remember hearing the story about, it was a rough year for the farm. And so with apologies to all the banks and bankers in the audience for this story, it was a rough year. So Papa Steve took out a loan from one of the local banks, and he put up his head of cattle as collateral for the loan. And unfortunately, it was a rough year, so he defaulted on the loan. And so it came time for the bank to collect. There's something flying around. It came time for the bank to collect on the loan, on their collateral. And Papa Steve told two of his sons, y'all take the good cattle and you put them back in the back pasture. Leave the sickly, scrawny, old, skinny ones here. In fact, put them out front. And so when the bank showed up, and they were greeted by the herd of sickly cattle, they did not collect on their collateral, and Papa Steve kept all of his cattle and collateral. And we still have the farm in the family today. So, again, apologies to all the banks for that story. So I'll start now. That's just a quick overview. Probably there's something flying around. This is Aiken Gump. We've got about 200 attorneys. This is like quick disclaimer. 200 attorneys in our energy group. We've probably got just under 1,000 attorneys worldwide. I don't know if you can read that very well, but we started in Dallas. Now we're all over the world. We doing energy all over the world. In fact, why Aiken Gump? Well, we've got a strong natural resources platform, international reach. We, like everybody else, we think we're distinct from our competitors. But we really operate as a fully integrated law firm. When Haley asked me to do the presentation, the last time I did this, it was mostly to a group of lawyers. This time around, she said, well, there'll be mineral interest owners, there won't be that many lawyers, that sort of thing. I was like, great, no lawyers. So I said, well, Canadian Texas, let me see what's going on up there in Canadian Texas. So I went on Google, and I just Googled, I think I Googled Canadian oil and gas, and I was getting too much Alberta, stuff like that. So instead, I Googled Western Anadarko Basin private equity. Because what I'm going to talk to you today about primarily is just trends in oil and gas and energy financing, but really a lot of what's going on right now with private equity. And this was a headline that came up, E&P Momentum Power Play in the Western Anadarko Basin. This was Hart Energy. The old is new once again in the Western Anadarko Basin as private independents revive the slumbering province. So that was January of this year. This next headline, and if there is anyone from any of these companies, I'm not going to pick on anybody, and if your company's here and you want me to mention your name, send me a note and I'll mention your name. Tom Ward-led company leads Western Anadarko acquisitions. The acquisitions represent the first transactions within a new partnership between Ward's Mock Resources and Houston-based private equity firm Bayou City Energy. So that was July of this year, July 2019. Another headline, Tecolote Energy announces record 4,070 barrel oil equivalent per day well in the Western Anadarko Basin Panhandle oil window. So another that was February of last year, still recent. Presidio Petroleum completes acquisition of assets from Apache Corporation in partnership with Morgan Stanley Energy Partners. So, in preparing for this presentation, which I get and what I understand is that nowadays you're not really seeing all of the old players. Like you don't see Exxon, you don't see Shell, you don't see the Chevrons. You see all these other independents and companies, and people kind of wonder, well, who are these companies? What's backing them? How are they getting financed? Where are all the old big names? So I hope to address that and talk about that. Oil and gas in the news. So I remember waking up on the weekend of September, around September 14th, September 15th, and hearing on the news, Brent crude oil jumps the most in history after Saudi attacks. Brent crude futures increased 19.5% to $71.95 per barrel. So that's our sort of international benchmark. Domestically, West Texas Intermediate increased 15.5% to $63.34 per barrel. So when I heard about the attacks, my first reaction was, oh no, I hope we're not going to war. My second was, I wonder how long these prices are going to stay around. Being a deal lawyer and working with oil and gas companies, price of oil matters, and that's what the clients are planning around, and that's what they're thinking about. So I'm thinking, maybe I've been practicing law a little too long, but I'm a little jaded and that sort of thing too. So I kind of wonder, well, how long is this environment going to stay around, and how much will this stimulate any activity in the area? So that was September 14th. 3 weeks later, Saudi Arabia says oil production restored to pre-attack levels. So it didn't last very long at all. So there was no heyday or boom town during that 3 weeks of time. So you're kind of thinking, well, what's going on here? What direction are we headed? Another, around that same time, oil drops to 2-month low on economic woes as U.S. crude stocks climb a third straight week. So, we've had sort of a mixed bag, especially since 2014. Seems like we've kind of really been in a down cycle in oil and gas, which affects energy finance and the trends in energy finance that I'll talk about today. Just another as oil prices sink again, OPEC plus managed to stick to their plan, which was just doing whatever they were doing. So, like we heard in one of the other presentations, OPEC, there's so much supply right now. An attack on Saudi Arabia it's not like the 1970s. We don't get this big downturn. It was just kind of more like a blip, and that was about it. So this is an overview that, after kind of taking all that in, here's a overview of what I want to talk to you about today, kind of a brief history of the shale boom, which I think is important to understand energy finance and the trends, like where we were and where we are today. I'll kind of briefly talk about private equity structures and companies, and a little bit about that model to satisfy your curiosity about that. And then I kind of at that point talk about sort of the trends that are going on in energy finance in terms of direct lending, being a gap filler for banks or working with banks in some cases. Some of the flexibility that comes from having private equity in the market. And also the role that private equity actually plays in restructuring and in downturns. And kind of one thing I feel like since in my career, I feel like there have been more boom-bust cycles in a short period of time than compared to prior years. And I think when you're dealing with oil and gas, that's something you get used to the boom-to-bust cycle, but I think people were getting better, the stakeholders are getting better at managing that process, and I think private equity is playing a role in that. So that's the outline of things, but just to kind of keep in mind, maybe there's kind of 3 general themes even behind all of this that we kind of keep in mind as I'm talking about it. One would be really what differentiates the U.S. from every other country when it comes to oil and gas and managing our oil and gas resources, and that would be private ownership of real property. When you work on these international deals, you're having to go to the government. The government owns the property. And really how fortunate we are to have private ownership of real property for all of the mineral interest owners who are here today. The second theme to really think about is kind of just entrepreneurial spirit. The people who go out there who are the risk takers, who are not like me, who are not very risk averse, but the people who are going out there and they see opportunities in the market, they see opportunities in a down cycle. And then third, just kind of like I briefly touched on the management of the boom to bust cycle. And a lot of people now, especially I think younger people, the boom to bust sort of wears them down, but people are kind of finding a way, I think stakeholders are finding better ways to manage that boom to bust cycle. So this is a very brief, oversimplified history of private equity and oil and gas, but I wanted to start here. I think it's important as far as explaining the roles that you were seeing in traditional commercial banks and energy finance, and where you're seeing private equity finance in the market now, and kind of the mix of the two. And I've started the timeline kind of in the early 2000s, which is really when I started practicing law. And at that time, there was sort of a convergence of fracking, the horizontal drilling, the urban drilling, the real shale boom. So I grew up in Fort Worth. And Fort Worth is a place where, compared to Houston, like in Houston, just about every piece of property is developed. Everywhere you go, there's no zoning inside the city. It's everywhere you go. There could literally be houses, and across the street there's a concrete plant. Fort Worth has a lot of open spaces, a lot of just open land, even to this day. And growing up in Fort Worth, I distinctly remember my elementary school was next door to I think it was like a convent or an orphanage. They had acres and acres of land, and they ran cattle out on the land next to my elementary school. And so, we'd go outside, we were kids, and we'd go outside at recess, and we'd look at all the cows, and that was just kind of normal life. In the early 2000s, when this is when I was starting to do a lot of energy finance transactions. I was representing some energy funds. I was representing some commercial banks lending money. I'd go back and I'd visit my parents in Fort Worth, and places like, that next door to my elementary school, I was like, wait, are they doing drilling, right there? So you started seeing a lot of those open spaces. Here's some activity, oil and gas activity going on inside the city. It was quite a sight to see. Chesapeake had an infomercial that came on Sundays. I can't remember if it was before church or after church or both, but a literal half hour, an hour about the Barnett Shale and everything that was going on. And everybody was excited in Fort Worth and surrounding areas. There was a big heyday inside the city. So at that time, there was a lot of bank activity going on, both on the private equity side and the commercial bank side. And then in December 2007 through about June 2009 is when we experienced the Great Recession. I remember working on a deal in early 2007. That was probably one of the most difficult deals I've ever had to negotiate. And as a corporate attorney, doing transactions is actually a good way to, you can kind of get a good sense of the market and where things are going. And usually when the so-called the bid-ask spread is so wide between parties, what should have been a very simple deal. I remember telling one of my colleagues, I think the bottom is about to fall out. Sure enough, it did. But, well, as a result of the Great Recession, we got the Dodd-Frank Wall Street Reform Consumer Protection Act, also known as the Dodd-Frank Act, which really, the reaction was, well, let's regulate. Some of it probably was needed, but you had the whole idea in the Great Recession of too big to fail from the bank standpoint. There are other aspects to Dodd-Frank as well, but for purposes of this presentation, just thinking about this is when we were all hearing too big to fail. This is when the banks were having to prove up their balance sheets and stress tests. And in addition to, so there was increased bank regulation. So in addition to all of the know your customer type of diligence that the banks were already having to do from the Patriot Act and all the anti-money laundering, they were also having to look at their balance sheets and prove up that they didn't have overexposure. And at that time, it really was the housing market. It was, everybody remembers all the things that were going on. But sitting in Houston at that time, I was still staying busy doing deals. There was still a lot of activity going on. And so we're sitting here thinking, we must be somehow immune here from whatever else is going on in the rest of the country. We're staying busy. We're doing lots of oil and gas deals. People were moving to Texas. People were moving to Houston. I distinctly remember there's a street called Kirby Drive that I go up and down every day in Houston. And every day, literally, I was seeing out-of-state license plates during this time from all over the country, California, New York, Florida, not just the neighboring states that you typically would see, like Oklahoma, Louisiana. I was seeing license plates from all over, and I realized, a lot of people are moving into Houston. There's still a lot of jobs going on here. Then 2014 happened, and oil prices plummeted. So at this point, banks were started cutting back as a result of the Great Recession, but then you started seeing, oh, now we really are getting hit with the oil prices down significantly. So you had the banks working in this increased regulatory environment from Dodd-Frank. At that time, I was representing a lot of oilfield services clients, and my clients were telling me that their customers were telling them, I want a 25% discount, I want a 30% discount. So the services companies were really getting hit first. Their margins were either thin or non-existent or negative, but they're still trying to do work and please their customers. During that time frame, a lot of the E&P companies that would have otherwise been hit by a downturn in oil and gas prices were actually hedged. Those companies that did have financing, their bank financing required them to be hedged. So they maybe were hedged at $75 barrel oil for 2 or 3 years out. So they were not experiencing the type of stress that you would have thought. But at that same time, they were also starting to sell everyone was selling their non-core assets. But kind of keep in mind when someone's selling, there's a buyer on the other side. So there were buyers on the other side who were seeing some value in what were non-core assets of some of these companies. So, and some of those were those entrepreneurial people who were looking for value or seeing value or thought that these assets were actually undervalued and they could turn them around. I was reading, and I kind of, during this time, so some of the E&P companies did start to file bankruptcy. There was definitely restructuring going on during that time period. Akin Gump has a big financial restructuring or bankruptcy practice in New York, and so our New York lawyers were coming down to Texas to help on these bankruptcies. And we kind of had to explain to them, well, these aren't your typical, first of all, the assets in the ground of these companies still have value, so this isn't like your typical sort of bankruptcy case that you're thinking of. And by the way, you don't call an oil and gas lease, you don't refer to them as the landlord and tenant. So we kind of had to get people up to speed on it. But what I was surprised to learn was during this time, around 2015, I was reading a report the Dallas Federal Reserve put out. The energy industry in 2015 accounted for 2% of Texas employment, which was down from a high of 4.7% in 1982, which I would have thought it would have been much. I need to dig into that number a little bit more. I mean, what do they exactly mean by that? 'Cause I would have thought that percentage would have been much higher. I think we heard in one of the presentations about 350,000 jobs today. I don't know if that 2% number from 2015 picked up all the other companies that service oil and gas, but maybe it would be much larger. From my perspective, it's over 50% from what I do day to day. But in any event, during this period, so this is 2015, 2016, both commercial banks and private equity, every banker I talked to, every private equity person I talked to said, we are limiting our exposure to oil and gas. Some of them are still doing some limited investments, but that was sort of the party lines. We are limiting our exposure. But at the same time, Permian Basin, which we've heard about today, you heard more. There was a lot of activity going on, still is, and you had companies that were selling their non-core assets and becoming pure play Permian Basin companies. There's just been a lot of activity in that area since, and what we came out of from 2015, 2016 is really more of a consolidation, I would say, in the E&P companies. There are some that were around that aren't around. The numbers probably won't come back from that standpoint. A lot of the upstream companies, basically the party line is we're doing more with less. We are becoming more efficient. I think they're still putting the squeeze on some of the services company, and that's helping them manage their own profit margins, but they're also kind of just working within their own cash flow. And so where we are, I think now, sitting from my view in Houston, Texas, as a deal lawyer, is that the oil and gas capital markets have been pretty sluggish. While there has been activity in the Permian, it was last year, first part of last year, I helped a client close, a PE client, close a sand deal in Permian Basin. So there's still a lot of there's stuff going on there. The big thing was we've got all this oil and gas, how do we get it out? But generally speaking, I would say the capital markets have been pretty sluggish because of all of the regulatory activity. The commercial banks it's really increased, and they're having a lot of hurdles that they're having to overcome to do deals and loan money. But private equity, kind of throughout that whole process, private equity has been there, and it's really been acting as a gap filler for the market. So just to kind of maybe demystify what exactly is private equity, generally I would define, or you can define it as an investment vehicle that's formed by investment managers, or sometimes you hear them called sponsors. They go out and they raise capital to make investments, multiple investments, through their fund. So again, this is kind of that theme of entrepreneurism, people going out and finding opportunities. And different funds, there's so many of them, and you kind of see funds that they kind of multiply and grow on each other. But they all kind of have some sort of investment strategy, whether it's if this list could go on and on. Upstream investments in the Western Anadarko Basin, participating in an experienced upstreams company growth by funding a drilling plan, supporting infrastructure in the Permian Basin, or you're an energy investment fund like the Morgan Stanley deal. And the list really goes on and on. And so who are the investors? So a lot of times the investors in the private equity funds are passive investors. They can be U.S. investors. They can be non-U.S. investors. They can be mineral interest owners. Some of them are teacher retirement funds, the Alberta Teacher Retirement Fund. It's a host of investors who are passive investors who commit capital to the fund, that the fund, they entrust the capital to the investment manager to go out and look for deals and get a return on that money for the investors. So the investors are in it because they're thinking about making money, they're thinking about retirement, they're thinking about putting their assets to work. So they get the investment manager to put their money to work and they pay the manager a fee to do it. So how does the manager make money? They get fees from the investors, so they're incentivized to take that money. They go out and they raise a fund, and they take that. They're incentivized to go out and put that money to work. But they also participate in the profits from the fund's investments, so the portfolio companies, the portfolio investments. Sometimes you'll hear that called a carry or a carried interest, which there's a lot of oil and gas, similar terminology to oil and gas deals. But there are many types of funds, venture capital funds that participate in the early development stage companies, growth equity funds that participate in sort of the later stages of a company, but helping companies grow before doing something like an initial public offering type of structure. You have buyout funds they take control investments in ma and pa type of companies or founder companies where the founder's looking for their own exit strategy. So they may take a control investment with the idea of selling the company or taking it public. And you also have distress funds. So this kind of goes back to that boom to bust cycle and managing it and how I think we're getting better. You have some funds that are distinctly their investment mandate is to invest in distressed assets at a discount and turn those assets around. So I put in this chart this is a simple fund structure, just to kind of, I hope you can read it, but this is sort of a general, very simplified idea of what a fund structure looks like. So in that upper, right corner, you see that's all the investors. The fund, which is where the investors put all their money into. The fund is managed by the general partner of the private equity fund, which is usually associated with the sponsor up there at the upper left. A lot of this structure is driven by tax law and corporate law and things like that, which I won't go into a lot of detail about. But you have their investment advisor over there to the side, and the investment manager, that's where generally all the employees sit and all the decisions are being made about where we're going to put the money to use. And the fund itself will invest in its investments through portfolio companies, and usually it's multiple portfolio companies that the fund is investing in. And here's just a sampling. Again, if I left your company out, let me know. But here's just a sample of some major players in the oil and gas private equity space. Carlyle, Blackstone, Bayou City, ArcLight, EnCap, Kane Anderson, NGP, Natural Gas Partners. The list could go on and on, but those are some of the names that you see nowadays versus some of the old brand names that we're used to seeing from the oil and gas companies. And I threw in this slide, even though it's kind of hard to read, just to contrast a hedge fund versus a private equity fund. 'Cause I think a lot of times people use the terms interchangeably, and sometimes rightfully so, because there's so many different strategies and they kind of start to blend together. But the thing to keep in mind about a private equity firm is generally it's got a life of about 8 to 10 years. So the investors, they put their money in. The fund has a lifespan of about 8 to 10 years. Typically, the investors want to see a return, usually, say on average 5 years. It used to be maybe 3 to 5, now it's maybe 5 to 7 years. But they want to put that money in, put it to work, make their money, and then get out. And so in that 5 to 7 year range, and then, between years 8 and 10, the fund just goes away. So a private equity fund, when they are making their investments, you have to kind of keep that in mind, that while they're in it not necessarily for the long run, but they have they're incentivized to get in there, make money for the investors, because they're thinking they've got to put this money to work and then be able to have an exit strategy in that 5 to 7 year time frame. So why private equity? And this is really something, part of why I started that timeline around 2000 when I kind of really started my legal career. I really feel like I've seen a growth of private equity in the market over that time span, and how much private equity is doing. In 2016, according to an Ernst & Young market report, there was $971.4 billion of private equity dry powder ready to be deployed. According to Practical Law, in 2017, there were 1,298 private equity funds in the market at the start of 2017. According to Bain & Company, by December 2018, $2 trillion of private equity dry powder across all fund types. And a report by Opportune says that the U.S. represents 80% of the value of global private equity deals in the oil and gas sector. So it's grown, its role has changed over time, and it really is here to stay until the next big idea, someone thinks of the next generation of it. So again, why private equity? Well, it offers flexibility, so to companies, to operators. There's fewer regulatory hurdles for the PE funds that they have to jump through. So a lot of times the private equity can act fast. And anyone here who does deals knows it's important to act fast and keep up the momentum. There's competitive pricing right now. There's so many. I attended a conference last Wednesday and Thursday in Dallas that was put on by the McGuire Woods law firm. It was an independent sponsor conference, which is sort of another term for them. The fundless sponsors. So these are sponsors that don't have a committed fund behind them, like the chart I just showed you. There were 850 people registered for that conference. These are people who, they are from all over, some from Texas, Chicago, Florida. They were from all over the place, and they were ready to do deals. There were capital providers there, and these people are ready to do deals. They want to do deals. And, I asked them, well, what's your background? What did you do before this? Oh, I was an accountant, or I worked at an oil and gas company. I wanted to go out and do something more entrepreneurial. I figured I have my secret sauce of how to do things and create value. So as a company, and ultimately if you are a mineral interest owner and you've got your interest or lease to an upstream company, what this helps for companies from their standpoint is they can go out and find sources of capital that are going to be tailored to that particular company's interests and needs, but that still fit within that fund's particular investment mandate and structure. Because of the increased regulatory environment, funds can take a little bit more risk now. They can act fast. As I mentioned, they're incentivized to put their investor money to work. And you see a lot of different strategies, but in some cases what they're doing is, I call it incubating a company until their exit strategy, but they're putting money in the company, participating in the growth with a goal of selling the company maybe to a major or doing it sort of an IPO or initial public offering of the company. Again, this is just some of the things when we deal with oil and gas deals, why private equity has a role, and certainly commercial banks obviously have a role as well. I don't mean to say that commercial banks do not have a role, a very important role. But some of the things we're dealing with private equity and doing oil and gas deals you have to think about are there's a lot of tax law and corporate law behind that structure that I showed you. There's different types of structures that private equity uses to invest, whether it's at the equity side or like through preferred stock, for instance, or through the debt side where they loan money to companies and the fund makes money by collecting the interest as well as fees from their borrower. And some of the upstream deals, you'll see a fund participate in the equity side or the upside through something like a net profits interest, or essentially we saw more, not so much right now, but because there's not a lot of E&P deals going on right now, but for a while we were seeing a lot of the companies putting in debt but also getting an interest in the actual underlying oil and gas assets. And there's all sorts of issues that you have to deal with. Federal leases, if the federal leases are involved, under the federal code, you can't have alien ownership of interest in federal leases, and so you kind of have to structure around that. And some of these funds have non-U.S. investors. There's all sorts of state real property law issues. If you have a deal involving Native American lands, they have their own sets of issues. So dealing with a private equity structure, you're able to kind of structure around and deal with some of those issues that come up in oil and gas deals. So I mentioned that the typical investment structures, so this is how they make their money through either, and this is a very simplified, either through equity ownership in companies, participating in essentially what's left over of the company after all their debts get paid off, and what's left if you're an owner, by loaning money to companies and getting the interest, getting the fees. And there's really there's a whole host there's mezzanine, there's all sorts of steps in between in the way that private equity makes their investments in companies, and sometimes doing a combination of both debt and equity. So this is just a kind of on the equity side, where you've got your portfolio company, you've got your sponsor. They have some of them take more of a control investment standpoint, and they go in to actually control the company. Some that will just want to participate in the growth of the company, so they might do what they call a non-control investment. Even with that, though, they're still going to want to have certain maybe veto rights or say in how the company is run. So they may want a board or advisory role or observer role on the board. They want to have control over major decisions of the company that they're investing in, like selling the company, like the company putting on debt. And then they're thinking about their exit strategy as well. And I've seen this structure as well, where actually one of my former colleagues left to work at a company that's private equity, that was private equity backed. You see some of the funds have put together a management team, or you see these people that are management teams. Usually there's maybe somebody with a CFO, financial bent, a legal person, and maybe someone that's kind of more of the business operator side. And they go into a company, make their money, they sell the company, they take all that money, maybe retire a few months, go back and find another company, do the same thing. One of my former colleagues, he's on his third company right now, and where he's not even doing the legal side anymore. And I think, well, I wish, if I had a little bit more entrepreneurial spirit myself, maybe I could be doing that. Maybe I'd be retired right now. And on the debt side, again, there's just a whole host of how the private equity puts their money in. mezzanine, credit funds, non-bank lenders, and then there's some, like I said, who specialize in distressed situations and finding those what they consider to be undervalued or distressed assets. Let's see, how am I doing on time here? Is that pretty good? Or is that 5 minutes? 15 minutes? And again, on the debt side, there's just a whole host of ways that the private equity try to replicate what the commercial banks have historically done as far as loaning money to companies. Whether it's a reserve-based type of transaction, funding an upstream company on a well-by-well basis. In some cases, participating, if a company goes out in an area of mutual interest, having the right to participate in those areas. Term loans, revolving loan type of structures. You can get into some really complex first lien, second lien deals, which right now I think seeing more of is commercial banks kind of doing a traditional asset-based loan and taking a first lien, and a private equity or non-bank lender coming in and taking a second lien on the assets. So there are as many combinations for how the deals are being done now as there are the funds and the investors going out and making the investments. And a lot of the times, like I mentioned, when you have the companies doing the debt deals, they'll get an equity kicker like a warrant and for the company's equity so they can participate on the upside of the company, getting a net profits interest or an ORI. I have one deal I've been working on where the private equity funder actually has, they call it an upside participation agreement. It's almost like a royalty. They take a percentage, so they loan money to the company, and then they take a percentage off the top of revenue. So they put some debt into the company, but then, so they were coming before even the owners, the common equity, they're taking a percentage of revenue off the top as well for their upside participation. So you start to really see some creativity there, and a lot of times when you have a company that's a portfolio company, that's a sponsored company, it can also help them get better deal terms with the banks. And all these slides are just kind of going into more detail about the debt side, which is really my favorite area to work in. But just the main driver, I think, is the fees. That's how people make their money, right? And so at the end of the day, that's what it comes down to. So even when I do these presentations to lawyers, people always go, well, what's the fee? What percentage fees are you seeing? How much are people collecting on these deals? This is just a slide kind of saying how they're getting paid off, whether it's sort of a traditional amortization or sometimes doing an excess cash flow sweep. And this is, again, more detail about debt deals that I won't go into a lot of detail about right now. But traditionally when they're doing debt deals, it looks just like a loan that you might see from a commercial bank. And then kind of going back to one of the themes we talked about, the boom to bust cycle, I think you do see some funds now that are distressed funds that deal in distressed investments, that are providing capital to companies or debtor in possession, DIP facilities, companies that are in bankruptcy, that are coming out of bankruptcy, an exit facility. You see some that come in, they call the fulcrum security, where they invest in a company, they put debt into a company, distressed company. When the company goes through a bankruptcy process, they end up becoming the owners. That debt gets converted into equity, essentially, so they come out of the bankruptcy process as the owners of the company. Sometimes you'll hear people call that a loan-to-own strategy. With the idea of taking the company, we put a bunch of debt on you. Now we own you, and we're gonna run you and operate you. So you see a lot of different roles for the companies of private equity funds. And so finally, kind of what does the future hold, and where are we now in energy finance? I think there's a lot kind of going on, a lot of different factors that are going on. I think the biggest thing, as I mentioned, was that there's really a lot of increased competition amongst the private equity firms to do deals. Everybody wants to go out and do deals, so they're competing with each other. So that's good for if you're an upstream company. That's good if you're a services company that's looking for capital, because potentially you have a lot of companies fighting over you to give you their money. So you're going to get maybe some good deal terms from that. So it's good for if you're a mineral interest owner, it's good for you, right? Because that upstream company is going to find some capital and start drilling and making money. I think right now we're still seeing, although there has been an increased commercial bank exposure and E&P deals, I think it's still at a reduced level compared to prior years. In one of the slides where I had the sort of first lien with the bank kind of doing a traditional asset-based deal with this private equity kind of coming in as a second lien. You're seeing that structure a lot because the banks are able to limit their exposure because they're just loaning against the company's reserves. So if there is a bankruptcy, they're going to be the first ones out, and they'll usually be able to recover all of the money that they've loaned to the company. Oil prices, stabilization of oil prices, I put a question mark there. As I mentioned, what I'm seeing when I talk to CFOs, you see some companies are basically kind of saying we're self-financing based off our cash flow. I think you're still seeing some pressure on the service companies from the E&P companies. But the E&P companies definitely are kind of lean and mean and efficient. Technology obviously has gotten a lot more efficient too. And that all these factors are kind of coming together. I'll plug one of my clients, Evolution Well Services. They're a fracking company, and they've got some really interesting technology. It's electrical, they're powering the fracking equipment through electricity, and they're using that. It's natural gas fired, so they're out in the field. We hear about all this gas that's getting flared and things. They're using that natural gas out in the field to power their equipment through electricity, and as a result, they're getting more and more efficient with their technology. They're saving their customers lots and lots of money, so there's a growing demand because they're saving their customers money. Their technology, they're also getting a smaller and smaller footprint out on the drill site, and they also have less noise. So you see advances in the technology, and I think that's one area where services companies have always been advancing technology and drilling, that sort of thing, in oil and gas. And you're seeing more and more of that, and you're seeing more efficiencies in the production, and so that's partly why we are where we are today. Is a recession coming? Probably so. I think that's probably the thing that we're all kind of most worried about, whether there would be a recession next year. Probably so. We're probably overdue for one. How will that affect? Well, I think it'll affect us, but I think we've been through a lot of us have been through, boom bust cycle. But again, some of that, what we're doing to manage that boom to bust cycle and lessen that impact, I think, are kind of seeing through some of the availability of capital. Some companies, so when I talk to some of my CFO clients, they're not hedged, or they're not hedging right now. They're thinking about hedging. It seems sort of counterintuitive, but they're kind of waiting for prices to get stable before they put on hedges. But in general, what you're seeing is, I think, right now in the market is just companies de-risking their balance sheet, and so they're not necessarily going out and borrowing money and getting more debt. They're kind of looking to more of the equity side and out looking for actual equity investments. So, and some of those investments that are kind of in between a pure sort of ownership or common ownership, and that are kind of more of a preferred stock where they can get a preferred return before the common shareholders get their return. But at the end of the day, I mean, I think especially for E&P companies, a lot of maybe the people here who are mineral interest owners, and maybe your check is smaller, like Mr. Rose was saying. Your check maybe is getting smaller right now, or you're maybe not getting a check right now. But it'll come back. It always does. But companies are definitely, we have all these factors kind of in the mix right now. But if you're an upstream company, you still have to feed your decline curve, right? You have to go out and you have to put wells online. You've got to drill. So you have that factor. Even if when the activity slows down, that still your company will go away. Solar, wind, renewables are obviously also having an impact. Driving between here and Amarillo and seeing all the wind farms was, to me, pretty amazing to see all of that. And just in general, sort of all the advances of technology and the efficiency that are going on. So right now, it's all, at the end of the day, it comes down to supply and demand as far as where we are in the market and what types of financing that are going on right now. And we're just kind of, I think in general, we're just seeing companies getting more efficient in managing their cash flows, and not a ton of real, new money activity going on right now, but just kind of people kind of, belt tightening, that sort of thing, and just kind of ready to ride the next cycle. But I think at the end of the day, though, I still would say there's still a lot of money being raised by private equity funds, and a lot of money that's sitting out there ready to be deployed. So if you are upstream company, if you're a services company, if you're a mineral interest owner, there's still a lot of money out there in capital and companies and people looking for opportunities. So, which I think is the upside of all of it, and that there will be more activity to be had in the industry. So, with that, that's the end of my presentation, and that's just my bio, if anyone wants to read it. But does anyone have any questions?
Any questions for Ms. Young? Oh, of course, on the far side of the building. One moment, please. Hang on. We got to get you on the video, sir. Give me 1 minute, please. Thank you.
Yes, you had on one of your slides a mezzanine fund.
Mm-hmm.
Could you describe that a little bit, please?
Yeah, mezzanine is something that's kind of in the middle between debt and equity. So if you think about a company, as a finance lawyer, whenever I do a deal, I have to think about the worst case scenario and a company going through a bankruptcy. And so if you're a secured creditor, you've loaned money to a company and you've taken a lien in their assets, you've got collateral, you're going to get paid out first as a secured creditor. So that they're, well, other than things like federal tax liens and special carve-outs in the bankruptcy code, generally speaking, a secured creditor is going to get paid out first if a company goes bankrupt. The people who are, at the end of the day, left holding whatever's left over of the company, and the residual value would be the common stock or the common ownership. If anything, if they own anything after a bankruptcy, right? Because everything might get wiped away and people are getting paid in bankruptcy dollars, and essentially maybe getting paid 10 cents on a dollar. So a lot of times, if you're a pure sort of equity common owner at the end of the day for a bankruptcy, you're not going to own anything. So mezzanine, what mezzanine is kind of in between that secured creditor position and a pure sort of common equity. And so the structure that I see a lot of times for mezzanine is really putting in some debt into a company, collecting the interest, collecting the fees from the company, but also putting in some sort of equity to the company, like maybe warrants or some sort of other equity. The structure I mentioned about doing a net profits interest structured like an override, where they're getting an interest in the actual real property assets, which if you go through a bankruptcy, there's a concept of executory contracts that can be avoided in a bankruptcy. Basically, if you have you probably hear a lot of times about celebrities that you think have all these millions of dollars, and they go through a bankruptcy and they get out of their contract with whatever music company or whatever. A lot of those contracts would be executory contracts that they're able to get out of in the bankruptcy. So that concept holds true for something like any sort of contract in a bankruptcy that's a quote-unquote executory contract. It can be avoided, which basically means the debtor in the bankruptcy can choose to say, I don't want to have to deal with that contract anymore. When you get for a mezzanine fund that's participating more on the equity side in addition to the debt side, what they might try to do is get that override, which would be an interest in the actual real property of the company and not just a contractual interest. So that type of interest, which is an interest in the actual real property, the oil and gas, will survive bankruptcy. That would be bankruptcy proof, and that was one of the one slide that had all the different kind of things you have to think about when you're structuring these deals. We work hard to make those types that you have to look at state law to see how it would be treated, but we work hard to structure those where if the company did go through the bankruptcy, at the end of the day, that fund would still have that interest in the actual real property after the company goes through a bankruptcy, as opposed to having had that pure sort of common equity where they may be left with nothing.
Any other questions? Okay.
Answered them all. Thank you.
Ladies and gentlemen, Phyllis Young with the Aiken Gump Group out of Houston.